United States savings bonds are one of the easiest ways to build for the future. Take stock in America. Buy bonds.
In early 2025, the world got a pretty rude shock. Trump wasn't kidding. Tariffs were flying, hitting not just China, but allies too. He was in the offensive, promising trade wars were just good and easy to win. He seemed relentless. But then, something shifted. A subtle change in tone, a quiet backtrack. Many pointed to diplomacy or politics, but the major part of the story wasn't in the meeting rooms, but deep within the financial system. The powerful, often opaque, multi-trillion-dollar US bond market, the very market that funds the US government, sent a warning signal so loud, so disruptive that even the White House couldn't handle it. Today, I want to dive deeper into this period when stocks and bonds fell together, defying convention. We'll look at why gold prices surged, acting as a global fear gauge, and crucially, we'll connect the dots to show how this intense market pressure likely forced the Trump administration to rethink its aggressive trade strategy, revealing vulnerabilities in the US economy with lasting consequences. This is the story of the market that roared back.
Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy.
To understand the market's reaction, we need to appreciate the sheer intensity of the trade offensive in early 2025. It was a multi-front economic conflict initiated by the US. In February and March 2025, the administration rolled out significant tariffs, especially on Chinese goods. China, playing by the classic tit-for-tat strategy often seen in game theory, responded with comparable tariffs. But the escalation was rapid and widespread. By early April, the US tariffs on certain Chinese goods hit staggering levels, jumping from 104% one day to 145% just the day after. China retaliated, pushing its tariffs to 125%. And it wasn't just China, long-standing allies weren't spared either. Canada, America's largest export market, faced tariffs based on questionable justifications. Trump even provocatively referred to Canada as potentially the 51st state. Similar tensions flared with the European Union. The administration's rhetoric was equally aggressive, framing trade partners as adversaries taking advantage of the US. The stated goal seemed to be forcing major economic concessions through maximum economic pressure. Initially, the markets were volatile but seemed to be trying to digest the news, perhaps hoping, against hope, that it was just posturing. But then the financial system itself started sending urgent, undeniable signals that the strategy was backfiring severely.
90-day pause.
Well, I thought that people were jumping a little bit out of line. They were getting yippy, They were getting a little bit yippy, a little bit afraid, unlike these champions. Because we have a big job to do. No other president would have done what I did. No other president. I know the presidents, they wouldn't have done it.
Think of the US bond market as the central nervous system of the global economy. It's where the US government borrows trillions of dollars by selling treasury bonds, notes, and bills. Investors worldwide buy these bonds and debts, and the price they're willing to pay, which determines the yield or interest rate, reflects the confidence on the US economy, their expectations for inflation, and their own appetite for risk. When this nerve center gets jittery, the tremors are felt everywhere. It's crucial to understand the basic mechanics here. Bond prices and yields move inversely, like a seesaw. When demand for bonds is high, prices go up and yields go down. This usually happens when investors are scared and seeking safety. They just rush to buy reliable US government debt. Conversely, when demand falls, perhaps because investors fear inflation will erode their returns, or they're just worried about the government's ability to repay, prices drop and yields go up. Higher yields mean higher borrowing costs for the US government. Now, let's pinpoint the reaction here. Around the time of major tariff escalations in early 2025, the markets threw a fit. The stock market took a nosedive, the S&P 500 plunged, wiping out significant value, reflecting immediate fears about corporate profits and the potential economic slowdown caused by trade disruptions. Initially, we saw the classic flight to safety. As stocks tumbled, panicked investors rushed to US Treasury bonds, pushing their prices up and yields down. The yield of the benchmark 10-year Treasury note saw a significant drop, indicating the initial wave of fear was driving investors towards perceived safety. But here's where the story starts taking an unsettling turn. The usual playbook is stocks down, bonds up. They typically have a negative correlation, acting as a ballast, if you will, for each other in a diversified portfolio. However, during the height of the tariff turmoil, this relationship broke down. We witnessed periods where both stocks and bonds were falling at the same time. When supposedly safe assets like US Treasuries fall alongside risky assets like stocks, it signals extreme market stress and uncertainty. Economic research suggests the stock-bond correlation depends heavily on whether markets are more worried about growth risk or inflation risk. Typically, fears of slowing growth make bonds attractive because of the negative correlation. But when inflation risk dominates, perhaps fueled by tariffs making goods more expensive, both stocks and bonds can suffer, as inflation erodes the value of future earnings and fixed income payments. This breakdown can also signal deep worries about fiscal stability or unpredictable policy itself undermining all assets. And this unusual correlation has happened in only a minority of historical periods, making the appearance as a significant red flag. Adding to the anxiety, China, a massive holder of US debt, reportedly began selling off its US Treasury holdings. This was interpreted as a strategic geopolitical move, signaling diminishing cooperation and putting direct upward pressure on US yields and raising fears that others might follow. And there was one more alarm bell ringing loud and clear: gold. The rapid spike in gold prices underscored the intensity of the fear.
It's going to take a little conditioning. It's a transition to, I think it's a transition to greatness. It's going to be greatness. Our country is going to be, there'll be nothing like it.
So the markets were clearly in turmoil, stocks plunging, bonds behaving erratically, China selling treasuries, gold soaring. Why would this make the administration pause? Because it had real-world consequences. First, rising borrowing costs. The upward pressure on bond yields, driven by sell-offs and inflation fears, directly translates into higher borrowing costs for the US government. With the national debt already standing at tens of trillions of dollars and significant amounts needing refinancing relatively soon, even a small sustained increase in interest rates adds billions to the annual interest expense. That's money diverted from other priorities, increasing deficit concerns. And it's a politically sensitive issue. Second, economic ripple effects. Falling stock markets erode household wealth as well as consumer confidence. Rising bond yields can translate into higher mortgage rates and borrowing costs for businesses and consumers at the same time, stifling investment as well as spending. The combined signals stoked fears of an economic slowdown or even a recession, the last thing any administration wants, and the latest economic data already shows a slowdown in GDP. Third, undermining the safe haven status. When even US Treasuries fell with stocks and major holders sold off, it threatened the status of the US debt as the ultimate global safe haven. Losing this trust fundamentally weakens America's financial power and could lead to persistently higher borrowing costs. Fourth, political fallout. Sustained economic anxiety is politically incredibly damaging. Job losses, rising prices, financial instability create all kinds of headwinds. While initial stock market dips might be dismissed, the deep tremors in the bond market coupled with unusual signs were different. News reports confirmed this. According to a CBS News report in April 2025, some Trump administration officials acknowledged that the bond market's hostile reaction to the tariffs influenced the decision to pause the tariffs. The report noted the turmoil in the bond market. Falling prices and rising yields got the administration's attention.
I did a 90-day pause for the people that didn't retaliate, because I told them if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate.
Did this market pressure lead to a policy shift? Connecting market moves to policy is complex, involving many factors. However, the timing of policy adjustments following acute market stress is highly suggestive in this case. What kind of shifts, you may ask? After the market turmoil peaked, we've noted a few things. One, announced delays in implementing certain tariffs. Second, granting of exceptions for specific products like consumer electronics. Third, a noticeable softening in aggressive rhetoric. And finally, a renewed but cautious willingness to engage in negotiations, even if underlying demand remains firm. China's proportional but submaximal response could be seen as signaling an opening for talks, a classic move in game theory. Again, attributing these shifts solely to the bond market is an oversimplification. Diplomacy, politics, lobbying, all of these matter. But the sequence is compelling. The market freakout provided a powerful signal that the tariff strategy risks severe economic consequences. As reports have indicated, key figures were paying attention. And it's reasonable to conclude that the intensity of the signals across multiple assets played a significant and contributing role in prompting a tactical adjustment or pivot. The market forced a degree of pragmatism.
And it had to be done. What was happening to us on trade, not only with, if you look at it, not only with China, but China was by far the biggest abuser in history, and others also, but somebody had to do it. They had to stop because it was not sustainable.
While the immediate crisis might have been tempered by policy adjustments, the events of early 2025 will leave deep scars and accelerated trends with profound long-term implications, particularly for the US dollar's global role and the perception of US capital markets. There's a fueling de-dollarization narrative. The concept of countries moving away from the US dollar isn't new. But episodes like this pour gasoline on the fire. When the world witnessed the US engaging in unpredictable trade policies that trigger chaos in global markets, causing even supposedly safe US Treasury bonds to fall alongside stocks, it inevitably raises fundamental questions about the reliability and stability of the US economy and the dollar as the world's primary reserve currency. This instability provides ammunition to countries and blocs like BRICS, Brazil, Russia, India, China, South Africa, and its newer members, which are actively exploring ways to conduct trade and hold reserves in alternate currencies. The trade war turmoil served as a stark, real-world stress test demonstrating the risks faced by countries heavily reliant on the dollar when US policy becomes volatile and seemingly, dare I say, weaponized. It strengthens the argument for diversification, even if building viable alternatives remains a long and complex process. This period also exposed the US capital market vulnerability. It was a wake-up call regarding the sensitivity of US capital markets, both stock and bonds, to abrupt and aggressive trade policy shifts. The unusual correlated sell-off hinted at potential underlying seismic risks and highlighted how political decisions could rapidly destabilize financial markets. Global investors were forced to reassess the political risk associated with investing in the US. If trade policy could trigger such chaos, what about other potential policy shocks? This introduces a new layer of uncertainty that can impact long-term investment decisions and potentially increase the risk premium demanded by investors to hold US assets, including government debt. This episode also raised lingering questions. Can the US Treasury bonds truly remain the ultimate safe haven if domestic policy decisions can undermine their stability? Will future administrations employ similar tactics, holding markets hostage to policy goals? These doubts, once sown, are difficult to fully erase and contribute to a more cautious global view of US financial leadership. The ultimate takeaway from this turbulent financial chapter is that while President Trump wielded the tariff weapon with unprecedented force, the powerful interconnected forces of the global financial market pushed back. The bond market movement was a major wake-up call to anybody who takes the status quo for granted. It was a verdict on the mounting risks of the trade strategy, reflecting fears of inflation, slowdown, and questioned US financial stability. They translated into tangible costs for so many different stakeholders. Higher borrowing costs for the government, eroded wealth, and heightened political risk. It stands as a potent reminder that in our deeply intertwined global economy, financial markets, while imperfect, act as a powerful and often inescapable check on political ambition. They reflect collective judgments about risk and reward, and their verdicts can also reshape policy trajectories. The future of global trade and the dollar as a fiat currency are very much up for renegotiation. What do you think? Was market pressure the key factor? Let me know in the comments below. If you found this deep dive into the intersection of policy and markets valuable, please give this video a thumbs up. It really helps the channel reach more people like yourself. And if you haven't already, consider subscribing for more analysis that cuts through the noise on finance strategy and global economics. Thank you so much for watching. Stay informed, stay curious, and I'll see you on the next one. Have a great day.